again, Bala sir, for agreeing to address our new PGDM batch. It's pleasure as always to listen to you. Students, for your benefit, I would like to mention that sir is currently associated with Aditya Birla Mutual Fund as Managing Director and Chief Executive Officer. Sir has been with Aditya Birla Mutual Fund for almost 26 years now. Last year only, sir completed 25 years in Aditya Birla Mutual Fund. Sir has been part of the mutual fund industry right from the initial days when the industry was very small and was growing. And today, when the industry stands at over 30 lakh crores, sir has been part of this journey throughout. Sir is also part of our board of governors. Sir has been our guidance force throughout. Sir has been guiding us on all our academic pursuits and corporate pursuits. Sir has been also giving time for addressing our students for almost all the batches. With pleasure, all our students have been benefited to listen to sir, to gain from sir's experiences as part of their academic programs. And today's occasion, there could not have been any better occasion than today's occasion, when students are just joining the program. In fact, the trimester 1 is beginning on Monday, and they are undergoing some orientation sessions. And we have Bala sir to guide all of you right on day one when you're about to begin your program, to highlight how you can gain maximum from this program, to introduce securities markets to all of you, to share his experiences. So, sir, it's our pleasure as always to have you here. And I know I'm standing between you and students, so without taking any further time, I would like to request one of our students to introduce you. In fact, sir, you will be happy to know the entire session will be moderated by our students only. So they will be managing all of it, and they will be always also interacting with you some questions at the later part of the session. For the benefit of audience, if you have any questions, please feel free to drop into our student Anto. So without taking any further time, sir, we thank you once again for this session. And Anto, I hand it over to you to introduce Bala sir to the audience.
Thank you, sir, for addressing the gathering. And we can't agree more to your comments. To start with, amidst the day of volatility, both on personal lives and on markets that are witnessing all possible permutation and combination of rise and fall across the globe, we have gathered here to hear from, learn from a composite, radiant, a charismatic leader. Let us put our hands together, guys, to welcome our legend of mutual fund industry, Mr. Balasubramanian, sir, the MD and CEO of Aditya Birla Sun Life AMC. It is indeed my pleasure to introduce him to the gathering. Bala sir brings with him over 26 years of experience in the mutual fund industry as portfolio manager, both in fixed income and equity. As a matter of fact, Bala sir has been part of Aditya Birla AMC since its inception. Prior to assuming the role of the CEO in 2009, he has served as Chief Investment Officer during 2006 and 2009. As MD and CEO, he currently oversees nearly 26 plus billion USD worth assets that are under management at AMC at Aditya Birla Sun Life AMC. Nevertheless, to mention that Aditya Birla Sun Life is one of the leading asset managers in India. He also oversees global mandates through its subsidiary companies in Singapore and Dubai, having assets of close to 1.8 billion USD, apart from overseeing alternate investment fund, real estate, and PMS. Bala sir is closely associated with key industry bodies. Currently, he is on the board of governors of NISM. He is also a committee He is also on the committee of corporate bond market development of SEBI. Apart from these prestigious roles, he plays an active role in AMFI as a board of director. He has also held the position of chairman of AMFI for 2 years from 2016 to 2018. It is no wonder that the pedagogy of Bharatidasan University never let their alma mater to be departed from rendering service to the arts and marginalized. Thus, Balasubramanian sir is involved with philanthropic work through various charitable organizations. He is actively engaged in initiatives towards mother and child healthcare and supporting Indian arts and culture. He is one of the active member at Satya Sai Sanjeevani Health Center for Child Healthcare. To mention about his academia roots, he has completed advanced management program from Indian Institute of Management, Bangalore, and Harvard Business School. He also holds a bachelor's degree in science in mathematics and a master's degree in business administration from GlobalX University. Once again, on behalf of NISM family, I welcome you to take over the session and fill us with your wisdom words, sir. Thank you. Over to you, sir.
Yeah. Thanks, Daniel Raj, and thanks, Ritesh, for having me part of the session today. It's good to be part of all of you as a student. I think the last session I addressed, I think the 1 year before the last year, I was physically present at the institute and I could meet with all of you, and then have an engagement with the highly energetic youngsters, millennials, who are now pursuing master's degree in finance and also to become the capital market player. Maybe I was in the exact position exactly 30 years back, getting into the capital market. And if you want to read some of my experience, yesterday there was an article interview which was done in the moneycontrol.com yesterday, mainly advising the millennials. And if you're all interested, you can just download it and see it. There I given my experience. Also, I given my experience in the same moneycontrol.com about a few weeks back about the journey of Indian capital market, and for my journey of the Indian capital market, how it got evolved over a period of time. And this is something also you may want to read it whenever you have a leisure time. And while the topic today is for value investing, I thought when you all begin your the academic course, getting into the MBA, value investing is actually comes later. First of all, for investing itself, we must understand fully what all goes in investment. Let me just open my presentation just a second. Yeah, you can see my presentation, right?
Yes, sir.
Yeah. So I thought first you should know on the investment world, what are the things that you must know as an individual, as a financial analyst, or maybe a capital market investor. This is something I thought you must focus, given the fact that 1 + 1 remains 2, whether it is 20th century or 19th century or 18th century, it doesn't change. Therefore, from the investment point of view, the common sense approach, that's a key for any investment that one makes. And the market, as you know, is driven by, capital market is driven by sentiment, optimism, growth expectations, and then the valuations. Valuation is one part of it. There are many components that goes into the capital market in determining the value of the company. Then comes actually is the value of the company is right or wrong, whether excessive or it's sufficient for the price that they are making, for they are getting. Either growth is sufficient, all such question marks will come. That's why the volatility sets in. So to begin with on the investment, definitely I think the understanding the business is very important. What does the company do? What are the problems the company is actually solving, right? Every company that sets in, for example, NISM is an institution, is solving the academic needs of the students, right? So that is the purpose of NISM as an institution. Therefore, every company is an ongoing company. When they sets in, there is a purpose for which it is set up. It actually finds a solution to a problem of the customer, either in the form of offering a product or the form of services, or maybe a wide range of portfolio of services and so on and so forth. That's called brick and mortar model. Therefore, one must understand what the company actually is trying to solve from the point of view of consumers' delight. And second is the companies can be actually divided into three parts rather. A company is actually the B2C or B2B, or B2B actually to the group of both, right? It could be a B2B and B2C mix. Therefore, from a customer, what is the connect that they're bringing in? Whether they are an intermediary company, there are many companies we take, they're all intermediary companies, but end product actually produced by somebody else. The various components goes into that, and therefore, so many companies have got a B2B model, and there are many companies which are a B2C model. For example, Zomato, which has come today, is actually a combination of both B2B and B2C, right? So the same way, in terms of the companies that operate in what kind of price points in which they operate, are they a player which actually the Me Too kind of a player offering at any price irrespective of whatever happens? And what is the premium well with which they operate? Just give an example. There are certain apparel companies in India, they operate in the premium segment of the market. I think give an example, Louis Phillips is a premium segment, whereas Peter England is not a premium segment. Peter England actually addresses the common needs of every consumers, every buyers, whereas Louis Phillips or Van Heusen or Raymond, these are all actually catered to the premium segment of the market, and some actually products actually cater to the mass. And there are products which actually only cater to the mass segment of the market, such as we can take 1 second. Yeah. So so that's another thing is actually to be looked at. Then finally, in terms of what the kind of input that goes in terms of the vendor service that it requires. I think if you look at Maruti is one example if I have to take, where they always take pride. He is not just only manufacturing car, they also have a huge network of chain of the service center that they have. That also comes ultimately in playing in building the business. Therefore, understanding the business is the first and foremost from students' point of view. Second is the understanding the industry. This SWOT analysis, which of course to be applied in every business. That's why I think the Peter Drucker model comes in. The entry barrier is strong. The entry barrier is easy. If you have to talk about my industry entry barrier is the least. Again, anybody actually has got an experience and can get into asset management industry. The same way in the case of NBFCs, anybody can get in. There are many industries like telecom. There are entry barriers. There are or maybe somebody wants to get into the mining. There are entry barriers. Somebody wants to actually build a road construction. There are entry barriers. Without those kind of qualifications, they cannot get in. Therefore, understanding the dynamics of the industry is something very important. The regulations surrounding the industry, again, as I mentioned, the 5-force portal model and doing a SWOT analysis, I think would play an extremely important role in understanding companies, understanding promoters, understanding the business, understanding the industry dynamics, both in terms of demand supply situations, and that something remains common. That's why I call it as the industry analysis. See, if you take actually any companies, whether it is automobile industry, or is the cement industry, or truck industries, or passenger car industries, or maybe telecom industries, or many such industries, if you take, the competition actually play a very key role in terms of demand and supply situation, and also the ability to price and offer products in the premium segment and so on and so forth. All such things actually play a very important role in determining and assessing the company's ability to deliver value for the shareholders. Then comes is the 1 second. Yeah. So then comes is the story of the companies. The story of the companies, especially, I think the last number of my own experience, the story can be actually built around 3-4 ways. One, the companies which are structurally sound business, it is going to long last for long because of the consumer will always remain attached to their company. For example, somebody makes a soap or somebody makes a toothpaste. These companies will remain relevant from the consumer point of view. There are sectors which are mildly cyclical structures or highly cyclical structures like cement or steel or aluminum or any other commodities companies. They go through volatile period. Oil, they all go through volatile period. They are all linked to the growth. They're all linked to the expenses that could be incurred by companies, the form of building the business and so on and so forth. And there are certain companies which are matured, stable industries, and that's something again could be the another way to assess this company's potential from the point of view of investing. And finally is the disruptor, right? I think disruptor is something which now is widely, I think you all coming into the capital market at a time that disruption is something is on the way. As it has happened globally, there are many companies which are old age companies, other than the companies that are making a product. Those who are in the services sectors, all of them have got interrupted or maybe disrupted because of the change in the technology, because of automation, or also because of the regulatory framework now increasingly making things more and more better from the consumer point of view. Therefore, the innovation has been the key success mantra for most of the global companies. Therefore, disruption is something. Also, some companies can actually come as a disruptor, and that's something we have seen it in the case of WhatsApp. Right, WhatsApp is a disruptor for SMS messages, which otherwise has been going through the telecom mobile phones. So therefore, many such kind of companies, again, we need to get the business story right before we get into the valuation and so on and so forth. Then comes actually is the annual report numbers. So the why I'm specifically saying annual report numbers, I think if we go and look at every company, they are duty bound to provide information as much as possible in every way. I think if you read the balance sheet right from the day, there used to be a time when I began my career in the mutual fund industries or maybe in the capital markets, we used to wait for the annual report to be, annual results to be announced, and then annual report to be printed, and then annual report to be dispatched and received at your house or maybe in the office. Then you will start reading the annual report to understand what is the director report talks about. Each director of the company will write something about the company, the futures. Auditors report, they will make a qualification. Auditors will make a qualification that yes, the company has abided by all the rules and regulation, on the basis of which, on the basis of disclosure information that is available. Every accounting actually in the books of account is fair, and therefore we are signing the balance sheet, right? All such statements, believe me, have got a greater impact in assessing the company's potentials. There are many companies where we also used to, of course, look at the kind of disclosure that they would have made with respect to the governance, with respect to the liability which is not taken, but the liabilities could actually potentially arise in case there are some legal issues or petition that happen. That's called contingent liability. But all such information, including promoter stakes, including the shareholding of pattern of the various shareholders, everything is given in the annual report. Therefore, for you as an individual and who are actually stepping into the shoe of capital market as part of your learning curve, definitely understanding reading the balance sheet annual report is most important. Is every word of the annual report, especially the director's report or maybe the auditor's report, extremely important. That's something is very important before you get into the valuations. Then comes actually is the understanding of the why is not moving. Yeah. Then comes is the balance sheet, right? There are two components in the annual report are very extremely important. One, of course, is the balance sheet. The balance sheet, of course, gives you a sense of how the money has been raised and how the business is being funded, right? Anything which is resources, it comes in your balance sheet. I think there was a time just when the Satyam used to happen, we all used to discuss the profit, right? Every company, what normally one looks at actually, what is the profit the company makes? And nobody asks a question that how the company has been growing, what has been the source of financing for every activity they do. Initial capital, the subsequent capital, do they borrow? Do they raise equity capital? Do they keep on borrowing more and more for building the business? Or do they generate enough profit for them to have an accrued carry forward cash balances? Or maybe do they have enough inventory that they have which is being funded? Or maybe they have over inventory, it's also being funded. There are many such things that comes actually in the balance sheet. At the end of the day, if the balance sheet is strong, which large is the source of income that comes in, related to ultimately the cash flow. If the cash flow is to be managed, and whether the company is free cash flow, all such thing actually is extremely important in the balance sheet analysis. Then comes actually is the profit and loss account, which largely is actually taking into account the way the companies will book their revenue, the way the companies will actually book their expenses, the way the company allocate various expenditure towards building the business, whether it is on the pricing, whether it is on marketing and selling, or there are many companies where we also value the company on the basis of how much of the money they spend on R&D. See, especially in a pharma company, if you look at it, the money they spend on R&D is always measured as a percentage of the revenue or as a percentage of net worth. It is to know how much the companies are committed to true to his business of investing in the R&D, ultimately creating a future pipeline of a product would depend upon how much investment that you make on R&D in terms of development of new product, development of new services, development of needs of that are more in the nature of automation, so that can help in creating a future sustainable business, while of course building the profitable business and along the way. That's something is very important. Second, of course, the P&L also many times tells you whether the company is actually making profit and paying tax, or the company is making profit but not paying tax. There are many companies, profit-making companies, they don't pay tax. They must be availing all the benefits which the government of respective governments would be giving, and that's something you avail all the benefit, then you don't pay tax. And finally, tax what you pay also is an indication of how strong the company is, how strong the cash flow is. Somebody is paying a tax, you will not pay tax without actually making profit. And that's also something is very important. That's what ultimately what you derive in terms of your profitability of the company, the net profit. Again, you derive the earning per share, which on the basis of earning per share, you derive the P multiple of the companies linking to the stock price. This is again something very important as part of your exercise. On the basis of this, the ratio analysis that you derive on each of these companies, whether it is a P&L analysis like revenue growth, gross margins, or EBITDA margin, or maybe the advertisement and promotion to the overall sales, and the same way on the balance sheet, return analysis such as return on capital employed, or return on investment, or maybe net debt to EBITDA, or interest coverage, all such things again would actually give you a sense on how the companies are managing both balance sheet and P&L. While doing that, it's also equally important to see whether the company actually is a free cash flow generating companies. many times in the business, the companies of course must be in existence, but keep on investing in the business, which could be a future in nature, or keep on investing in the business with knowing very well, or maybe not knowing very well, that some of these products will become obsolete. I'll give an example in companies where we used to track very closely companies that are not free cash flow generating companies. Generally, we tend to actually avoid for one simple reason, that these companies will only keep burning cash and unknowingly or knowingly putting money after the same product, which could potentially become obsolete as a period of time. To give an example, there used to be days where all of us used to see the tape one that we always use, tape recorder, and then the companies which are focused on building or rather producing tape recorders eventually became the disc, and today is all come in the pen drive. Even the disc is also not so much being used. Just imagine somebody has put actually a huge amount of money behind the form of a capex and producing the old style the tape based the instrument, then naturally those companies would have got out of the market. There are many such companies which I have seen in my own lifetime. Given the fact that this management did not have the vision how the industry will evolve in future, therefore all of them become obsolete in the business. I think I'm sure you all would do a case study on Kodak. That's interesting case study that I would encourage each one of you look at how Kodak as a brand, which all of us used to see. I used to remember a gentleman who actually I used to advocate value investing in India. He went wrong majorly in identifying Kodak as a company way back in the 90s. I used to say that the Indians, or maybe worldwide, every individual's the interest towards photography will increase. Therefore, Kodak as a company would become the large company because individuals, not only the photography will increase, they'll keep actually using the rolls and keep taking photographs with the families whenever they are in a tourist destination, and therefore the volume will increase significantly. Therefore, these companies will be one of the bigger investment opportunity for one to make. And nobody would have visualized at that point of time the entire model of Kodak would get converted to digital, and therefore the whole usage of film-based photography would disappear. This way, I think company can also even get it wrong, even in the value-based companies. And finally, is the capital efficiency is something which is again very important. There are many companies do not measure the capital. It's basically ROE, or return on capital employed, or return on assets. All of them actually reflects how we are generating a profit by the same assets and making the assets sweat. It's all asset sweating strategy. There also is very important actually into a ratio analysis when identifying companies that one wants to make as a potential investment opportunity, taking into account all these aspects. And the other point on the basis of this, clearly, as I mentioned earlier, itself, the accounting policies, that contingent liability. There are many companies suddenly become bankrupt, not because the balance sheet was weak, not because of they are not able to generate enough profit, but they have so much of contingent liability that something would come and suddenly come and hit you, despite it being disclosed in the balance sheet, but not many pay attention to the contingent liability. As a result of that, there will be huge liability that will come, and therefore the company can become bankrupt. This also is something very important in understanding the notes to the accounts. The last, of course, is also about derivatives. There are many companies undertake derivatives transactions. Sometimes derivative transaction which will be much more than the exposure that they have. For example, I have $100 million of exports, and the currency hedge that I can take should always be only for $100 million. Suppose I have $100 million exports, then I have a $50 million import, right? So then import versus export, what is left out is only $50 million. The $50 million of import, $50 million exports is naturally hedged. The $50 million is actually remains is exposed not with no hedging, and therefore such kind of hedging also need to be covered. There are many companies actually have a strategy, a policy which are laid out internally. Therefore, how they are spelled out, such thing also is extremely important while doing analysis of the companies. While doing that, finally comes to the valuation. This something is actually is about value investing is comes on the basis of this. That any company that you value, there are basic principles on the basis of which these are all thumb rule based valuations that we can apply. P based valuation. Today you can actually take a simple matrix of the earning per share and then apply the the multiple that you want to provide in the form of PE and arrive at the stock price. Also, you can apply on the basis of the price to book. For example, you as an individual, I'm just giving an example. Any of you as an individual, let us assuming your net worth is say 10 lakh rupees. That's your price to book. 10 lakh rupees net worth is your price to book. At the same time, you are at the age of 25 or 26 or 23. You have another 35 years to go, and probably some of you would become would probably start earning millions of dollars. Then I start discounting your potential earnings of the future and then arriving at your net present value on the basis of which I arrive at the price to book. On the basis of the potential, somebody is actually out of your team. If somebody is going to get, say, 5 lakh rupees per annum as an income, somebody is going to say get 20 lakh rupees per income, somebody is going to say get 1 crore rupees per income per annum, then naturally the multiples that you provide would vary. The person who gets 5 lakh rupees will get the mediocre price to book multiplication. At the same time, somebody is 20 will get higher multiplication. Somebody will get 1 crore will get a substantially higher multiplication. So that is the way the P multiples changes, price to book multiple changes. EV to EBITDA. EV to EBITDA is nothing but market cap plus a debt. If somebody has to buy out this company, you are liable to market cap. You're also liable to the debt in the company, right? Both of them are, you are liable as a by any buyout that you do. Then when you buy out such kind of companies, the economic value of the company, which is a combination of market cap and the debt in the company, if you take these two combinations, if you take it, then divide that by EBITDA multiples. EBITDA is nothing but earning before interest and tax and depreciation. That's something if you take, and that number actually determines what is your payback period. That payback period determining the company's payback period, it can be 5 years, it can be 10 years, it can be 20 years. That's something again depending upon what's the kind of payback period one has to look at it while actually again determining the company's valuations. There are many such things that you can take, the EV to sales or price to cash flow, and then the capacity utilization, or maybe the replacement cost. Many of the companies in India, this is where I think value theme also comes. There are many companies who have got a replacement cost would be substantially higher. If somebody wants to see the way I think they measure the cement industry is the EBITDA per ton is something they measure. $180 per ton is the EBITDA per ton is the valuation that they apply. In order to create 1 ton of cement capacity, taking into account the land cost involved in setting your factory, taking into account the machinery that you have to buy for producing cement, and taking into account the people you have to build, all such things put together, what is your cost of setting a cement plant today? And that cost of setting a cement plant has to be lower than say $180 or $200 that exists today. If the cost of setting up a cement plant is more than $200, which currently the market that currently assumes, then naturally the replacement cost actually is higher than the current market. Therefore, the market price will start moving up. At the same time, if the current value is so much, the replacement cost actually can be substantially lower. That is the time actually anybody actually who gets in the business, he will come that I'll of course step in because the price advantage is there for me. So therefore I have a visibility. I'll now come and set up a shop. That's why I think most of the companies actually look at the expansion of the business. Therefore, replacement capacity I think will be, replacement cost would be another key metric that one should look at it. Then Dcf analysis is the, of course, the discounted cash flow methodology or discounted dividend yielding methodology, or even net asset values, of course, is overall EV equal that you can see. And finally is the SOTP valuation, which is the sum of the parts valuation. There are many companies, I've got small companies below them. Therefore, each company creates a value, and that value actually how does it add to the top line company? If you take Bajaj Financial Services Holding, and they have many companies below them, on the base of it they build the overall business they have built. And as the companies keep creating values, like the father's network, actually the network of the son. As your son starts generating more and more earnings, then naturally family wealth increases. As the family wealth increases, the father and mother wealth also increases. At the end of the day, whatever we generate actually belongs to the father and mother, as it's applicable the other way around, right? The same thing if you have to add up to the business, SOTP valuation also makes a huge difference in valuing the companies. Therefore, while valuing the companies, it's also important to consider what are the broad agenda of the management in growing the business, and how in growing the business, how much of the money they need to expand the business, and how much of the money out of which will come through the form of equity or come in the form of other alternate form of financing, including debt borrowing and any such liability that they have to create, other source of financing will come. And then how long the business would actually be taking for turning it around. And today, if you take a Zomato kind of companies, they are now gone on record. If you just go and read their offer document that they filed with the SEBI and also see their presentation, clearly they are saying as a company, it will take 7 or 8 years to make profit. They say it upfront on the basis of opportunity, and then saying I'll take 7 years to make profit. Is it a value company? Is it a high growth company? These are high growth companies, not a value company, because they're not generating profit, they are generating loss, but the loss is coming down, profit keeps rising, and the profit for the future will keep rising and the losses will keep coming down. If the costs remain the same, the profit keeps rising if they have a pricing power. if the more and more people actually start using Zomato for ordering foods and other things, and also able to give a higher prices for the convenience they are providing, therefore the ability to increase the profit also increases. This way, the market starts valuing it. Like Facebook, if you take globally, is it a value company? Is a high growth company? It could probably a high growth company, but not in the value company, right? There are companies actually they don't make profit, but the future profit potential is very, very large because the addressable segment which is operating that you and me are ability to actually pay the price over a period of time for using the service is also high. So that's why most of the companies first give free, and then first you get in, and then make you pay, and eventually they start making profit. That's the way Amazon kind of companies have been built. And finally is the landscape in which the company is operating, and also what the kind of investment they are making in the case of technology to making the company survive in the future. And finally, on the base of this, make the investments on the base of this analysis. Then comes actually is your value investing and growth investing. On the base of this analysis, once we identify which is the segment in which the companies fall, that each of the managers in the country or each individuals, they start, I think they start making assumptions that what are the features of this company in terms of growth, and finally they tag themselves as a value investor or maybe the growth investors. I think if you see here, there are many people in the world, they follow the value investing principles or growth first style of investing. Classic value investing approach is Ben Graham approach, and also the Buffett, Charlie Munger approach also is mostly the value approach. Purely on the base of the balance sheet, cash flow analysis, the company has to generate cash, company has to sell the product on a consistent basis. The consumption of the product should not be volatile. So whether it is in this generation, old generation, Pepsi will continue to be consumed, Coca-Cola will continue to be consumed. At the same time, cigarette will continue to be consumed, but it will become risky and riskier. Then the question is whether you want to look at is a sustainable value investing, but not sustainable, also get knocked off. So that is a way approach which Buffett and Munger looks at it, whether the business can come for the next generation or multiple generation. For example, they have bought into companies in the US which are the goods carrying companies, the railway flight that they have. And that's again something they have taken a call that these companies will continue to carry goods across the US. Therefore, they continue to generate revenue, and therefore it will become a cash generating company, and therefore they will get high cash flow generation from the company and high dividend from the company, and therefore they will be able to create value for the investors in the longer term. There are certain people actually invested, Peter Lynch way of investing broadly is a base of growth investing. The way he of course invests is actually go and shop around in your mall and suddenly you find a product and then see which is the company producing the product. Then you go to another mall and look at a similar product or maybe a varying product. Again, look at who is the manufacturer of this product, and suddenly you realize, oh, this company is producing this. I am buying this product on a daily basis. Therefore, many people will be buying this product like me. Therefore, the company making profit, hence it become a high growth company. That's the way Peter Lynch actually goes about building a business. So that something is again value model. There are many such models of course exist. Therefore, while investing, clearly please remember there are 3-4 things. One, analyzing the business model, getting the industry story and the broad opportunities in which they operate, applying the 5 force model of Peter Drucker 5 force model. After applying that, and finally deep analysis of balance sheet and profit and loss account, and to understand how the balance sheets are constructed to fund the business and how the resources being used effectively for the purpose of building business, for generating profit on the P&L side, and for generating a profit, whether they have the right cost structure and right model to actually make the investment and the right investment and so on and so forth. And finally, read the balance sheet, every aspects of balance sheet in terms of auditor observation, qualification, accounting methodology, the management principles, the change of management, all such things ultimately derive the selection of companies from point of valuations. I think each of the aspects are being applied, whether it is a value investing or growth investing. And then finally, you have to decide that which is the path I'll take, that free cash flow companies I'll stick to, Therefore, I'll be a value investor, or look at companies which are a future-driven, future business drivers of the business, and therefore I look at such kind of high growth companies. This is the way I think one has to divide their entire approach to the capital market investing by way of doing great analysis on companies, the business model, and so on and so forth. I think I'll stop here, and now I'm sure you all must be having a lot of questions. I'll be happy to take those questions.
So much, sir. It was really informative for our juniors who are like just starting in the industry, and letting them know the brief of how the value investor. So how should a value investing should be thought of, how the process are in line. First, sir, I would like to congratulate you on 3 lakh crores AUM that you crossed yesterday. Very much congratulations. And sir, you have been in the industry from past 26 years now. So would you like to share any experience you have for a students that really change the perspective of how you're working in the AMC so successfully from past 26 years now? So any experience that would be really helpful for our juniors for year 2, like year.
Yeah, I think that's interesting. Harshika. See, one, of course, when I look back in my own career, I think what has remained constant is the change. So what has remained constant is the change. And therefore, in every change, how you are able to adapt yourself is something, it's a key to the success. That many people may accept the change, and many people may not accept the change. Therefore, in order to remain successful, I always believed change is a constant. Therefore, any change that comes on your way, accept it as a way of life. Don't analyze it. Accept it, don't analyze it. Right? Once you accept it, then you will be able to find the way of addressing that apprehension or concern that you may have, and then move forward. That's one first and foremost principle. Second, which of course, I have in my own early career, I used to have one different kind of thoughts that I must be indispensable. It is not something. Nobody teaches you. Nobody tells you. And no, actually, in the making organization point of view, indispensable is a bad word, because for them, depending on one person, dangerous for the organization. But imagine from an individual point of view, if your dependency, if you are able to create a dependency on you, very, very high, then naturally, if you remain relevant in the system and you remain dependable, indispensable for the organization, then naturally you are able to establish yourself as somebody who is dependable, trustworthy, whom I can entrust a job. Therefore, you'll get more and more jobs. So there used to be a time in my own case, I used to get a lot of jobs every day. Job in the sense work, I'm saying. When I mean job in work. Every day I used to get additional work, and every additional work I'll do it without even cribbing, or without even keep your face small, and why so much work has come, and so on and so forth, right? And this is the way I think I used to get more and more work. As the work started happening, of course, I used to also work on automating some of those stuff. Most of the time we have a routine. I am always a believer, routine work has to be carried out, but routine work can be done so efficiently so that your routine work keeps rising, right? So your routine work also, the scope of routine work can keep increasing, but by way of increasing each of your routine work more and more efficient. And that's something, again, has been one of my key focus area right from inception. I'm giving you simple stuff. And last, of course, I think one need to bring in a passion. I think mostly you should love your job. You should love your job. You should love your the responsibility you take. See, most of the individuals, they come into, of course, in the business or field of working or getting into the company with the aspiration. They start with the aspiration, and then the aspiration not able to meet, and therefore they start getting that the path get changed. Then you go pursue something else. Again, path getting changed, you don't get your path right. I am a believer, if you are destined to get something, you will get it, hook or crook. But the question is whether you want to pursue that, or you get to the right place, the right organization, at the right time, and continue to put your best forward, then naturally your destined path also will be drawn along the way. This is my belief. In today's world, probably this may not be the one which I think people will take it. Some will take it, some may not take it. But somehow this was my initial way of living. I think when Daniel introduced me, he smiled when he read he's a BSc Mathematics. Maybe he would have probably thought he's doing BSc Mathematics, but he's in the capital market doing finance, right? This obvious question would have come into your mind. Just imagine this, right? I want to pursue engineering, but get into the capital market, and now I spent 30 years and reasonably successful. I will not say successful because self-boasting cannot be the right thing to do. But that's the way, right? That's again would have come along the way. But thing is, because I was mathematics, did I ever did not want to actually learn about finance? But then the moment you do MBA finance, they automatically taken care, right? So that's why I'm saying the path can be, of course, laid out, but for which you need to have an open mind, passion, love your business, and put your hard work and create a presence for yourself. And that's something you do it. To give another example, there used to be a time 5:30 means I will not run away. See, there is a school of thoughts, right? 5:30 means run away because you have to reach home. Then the question is whether you put little extra hours and spend more time completing work, help others, and therefore actually next day when you come, nothing is pending, you're going to start to refresh. Assuming you are able to do that, then naturally the growth path for individuals would become that much visible, I would say. There's no certainty for this, but that much more easier visible.
Thanks so much for your perspective.
Very, very rightly
Next
said, sir.
question, yeah, Manik would be taking
Yeah,
next
so
question.
sir, you mentioned about reading and analyzing annual reports while taking the investment decisions. So what are the key factors or pieces of information that an investor should look at while initially picking a specific stock or screening a specific stock?
Yeah, when you look at a specific stock, assuming you pick one company, randomly you pick one company, and then you want to make investment in this company. See, for anybody of your nature, anybody for the matter, first what comes actually is your price of the company. Then I immediately go and check how the price of the company has been moving. Last 1 year, 3 year, 5 year, and so on and so forth. Then comes is your analysis, etc. Therefore, when you pick up the company, one, you must understand what the product of the company is, and what the company is, what produces, what service it provides. Then naturally, the moment you look at that, you will know whether it is a high consuming product, or potential of consumption of the product could become very large, or maybe the services can become large, and so on and so forth. Then we start looking at who are the management was driving it. So that the companies, the profile of the company's management, how long they've been in existence. And these are some of the basic questions I think one has to ask while looking at that. Then comes actually is your other analysis which I mentioned about it. And this has to be, it's a filtering process. See, every investment, there are 5,000 companies are there in the Bombay Stock Exchange listed companies. You can never make analysis on 5,000 companies. You need to have a filtering process. From a larger set, actually, you do a filtering process. For applying principle filtering process, in my slide, if you take each of those slides of mine, should be forming part of the filtering process. Story, filtering process. The management vision, filtering process. The balance sheet analysis, filtering process. The moment you do using the filtering process, bring down this company's universe that you're looking at it to a smaller universe. And from that universe, actually you start looking at value versus growth and so on and so forth. This is the ongoing thing that one has to do. And there's absolutely no shortcut for this. There is no escape from this as well. And the moment you do this filtering process right, believe me, you get 60% success. 50-60% success you get it. Or not even 50, 30% success you get it. 50 is also very high. Filtering process is the first. Then comes the analysis.
Thank you, sir.
Yeah.
Next, I would like to ask about ASD. You are one of the few AMCs which are already having an ESG fund separately, and we are new to this. And only 10 of our total funds are there in ESG. Aditya Birla started it at December 2020. So, how do you see ESG as a fund working in an Indian market, and what would be its growth trajectory if we see environment, social, and governance continue as a whole? So, do you see our Indian generation actually thinking of it and investing in the mindset of ESG?
Yeah. See, this is ESG is something it's related to the environmental, right? I think today, what are the most expectation for everyone globally? I think since the time the Paris Agreement, what they call it, right? The environmental agreement, which I think US has been driving, all the G8 countries have been advocating, and India too, they have been advocating the environmental need to be taken care. Otherwise, there will be many disasters in the world. And one is the carbon emission. If it continues to remain high, then naturally it will have the natural disasters. Therefore, the whole economy could be at risk. That human beings will be at risk, and this is the way I think the whole environment will become a serious part of discussion everywhere. So, who are the people responsible for this? Like Swachh Bharat, is we are responsible. So, whatever the usage that we have, plastic bags, don't use it. And we all, as a consumer, we use it, throw it. So naturally, it creates a environmental hazards. So that's something every company has to follow. I mean, you and me as individual have to follow, and every company have to follow. The moment company starts following, I think as an investor, eventually, they will start respecting those companies who become more and more responsible. ESG is nothing but responsible investing, responsible way of building the business. So I'm accountable to the nature. I'm accountable to the impact on social. I'm accountable as governance. Governance is something, is a wider subject. It can't be defined. But if governance is something, the way you want to pass an accounting entry. I'll tell you the governance, the biggest success story of Apple. I'm sure you must do this case study and whenever you get an opportunity. See, the governance is something, some of the companies globally became a failure, is a governance. Apple case study is an accounting governance. I think you sell the product, sell a mobile, right? Is there any warranty for this? When you buy a mobile, there is a warranty, right? How many of you would avail
warranty generally?
There is a warranty for generally. How many of you would avail warranty so far? Anybody, any of you avail the warranty so far? No, right? See, there is a warranty, but none of you avail the warranty. So then this was Steve Jobs challenged the accounting CFO, saying, boss, I'm selling a mobile phone and I give a 5-year warranty. It's 100 rupees, say, let us take $1,000 mobile phone and then selling it for 5-year warranty. You and me as a consumer go and buy it. Then the CFO of the Apple is saying, because there is a warranty, $1,000 to be booked over a period of 5 years as a revenue. Because there is a warranty. So otherwise, somebody comes and tells me that your mobile is not doing well, I am duty bound to take the mobile back and give him a new mobile or get the mobile repaired, right? So therefore, the CFO is saying there has to be a madness to methodology in terms of accounting of this. Then Steve Jobs asked a question. You guys have been selling millions and millions of mobile, but how many of the consumers so far have come avail the warranty? So nobody has done. I want you to book all the 1,000 rupees revenue on the day you sell, the year you sell. That is the time revenue starts going up. So this is what he challenged it. At the same time, other way around also happened for some of these companies. There are many companies, I sell a product, I get an agreement. I say I'll supply 1 crore worth of machines to you next month. Now is the month of September. So now is July. Then I tell somebody I'll give you a supply of machine in the month of October. Is it a revenue before September? Can you book it as a revenue? Arshika? Can you book as a revenue? Sales?
Not exactly.
I am supplying an equipment. So you are buying an equipment from me. 1 crore worth of equipment you are buying from me. I am getting into a contract with you for a delivery in the month of October. Can I book this as a revenue for me in the current quarter, which is the July? Right now I'm in the month of July. When I report my quarterly numbers in September, can I book it? No,
Yes, sir.
right? Companies in globally used to do that in the early part of 90s. This is the way they used to, of course, get into a contract. And the contract, they used to take it as a revenue. And the contract doesn't get materialized, contract get cancelled. Then the revenue cannot be booked. The sales cannot happen. Till such time the goods get delivered, move from you to the buyers, you cannot book a sales. So this is again part of the governance. There are many companies in terms of this kind of governance practices, extremely important while determining the value of the company. Therefore, those companies who do not provide enough care on the environmental issues, companies do not provide enough care on impact of that in the social element aspects, and finally, companies do not have enough governance standards, they do not get valued properly. That does not mean all the three who are not following will not exist. They will exist, but they will also become irrelevant player, or they will become marginal player, given the fact increasingly people only look at only those companies who have very good following for good care for ESG, are the one who will become the way of investing globally over a period of time. So this, I think, we are just the beginning, and this is the way I think even most of the global companies are now making the companies with making investment are responsible. This is one way to drive influence the companies to make investments on environmental aspects, on social impact that they should give, on the governance side. The moment you know, if you're not ESG compliant companies, I'll punish you. I'll punish you in two ways. I'll not invest. Because I don't invest, the P multiple comes down, price comes down, price doesn't appreciate, right? That's what happens. And that's the message that one gives. And today you can find many companies who are not doing well despite generating cash. Therefore, you will come with the assumption that I'll create value company, but not necessarily they will create a value for you because they are not ESG compliant companies. Yeah. Now, I just want to give an example so that you're all able to get it. Yeah, investment is something, it's a common sense approach, but we may always complicate looking at balance sheet and other things and complicate things, whereas investment is more of common sense investing, the more well understood principles across the world.
Thank you, sir. So the next question being, while your presentation, you rightly noted various factors and tools which were to be looked at before investing into company, and which were part of the fundamental analysis or value investing, we can say. What role does technical analysis, or does technical analysis also play while investing in a company, or let's say as a fund?
Yeah, see, in anything that you do, you always look for some confirmation, right? So we have done an analysis, but you want some confirmation. So what is the confirmation that you can get? Confirmation or reinforcement or confidence building can come through the technical analysis. But technical analysis, basically, if you like investment world, there are two parts of the investment. One is the science and second is art. Art is a gut feeling. See, anytime when you do, gut feel also comes in the way. I think once you start working, most of your decision making will be driven by the gut feeling only. So all your decisions will be on the gut feeling, not with a number analysis. Therefore, when you look at technical analysis, also there's a trend that exists. The market is saying something, whereas you are saying, you are thinking something. Then you do a mix and match and marry these two things while taking investment decision. On the basis of technical analysis, you see companies falling. but you only look at the valuation and don't pay attention to the market price falling, then naturally market knows something beyond your assumptions, or maybe the market is wrong, whereas you are right, right? But one of them will be right, and one of them will be always wrong. This is zero sum game at the end of the day. So therefore, the technical analysis is something would give you some sense of revalidation of your assumption, or giving some heads up on your assumption that you are making before you take a call in terms of entry or in the form of exit, right? Either side you can do. Either will enter the stocks or will exit the stocks. So in both the cases, in some sense, technical analysis will come in handy. But the moment you are a fundamental investor, technical analysis is not the base on which you're making the investment. That's only the additional point that you take.
Got it, sir. Thank you.
Yeah.
Yes, sir. This side Dinesh Patil.
Yeah, Dinesh.
Yes, sir. My question is, everyone can start a company, but the main factor is to make company sustainable during, like your company. You started some years ago, but you sustain in the market for longer. That is more important. Then, if company's cash flow is very good, if company's market and sales is very good, then which factors we keep in mind? Long-term sustainable, which factors are important for the market analysis?
Yeah. See, any sectors that wherever you think irrespective of whatever the government, sometimes we say we as a country growing despite our politician being there, right? That's why sometimes people make a comment like this. What does it mean? That there is no intervention of regulation, there is no political intervention. Even if there is no political intervention, nothing can be done because they're operating in a segment which have got a long-lasting nature as a business. The elasticity of power of the pricing is also high. The consumption will remain very, very strong, or consumption of service or consumption of the product, right? Both will remain very, very strong. Therefore, the companies which are most sustainable is on the base of the sustainability of the business, because the opportunity remains very, very large. Basically, the recurring consumption or recurring usage of service. That's one way of looking at it. Second is the untapped potential remains very, very large, but at the same time, we are not growing enough. Even if I grow at say 15% or 20%, there's still opportunity for me to go and tap. They're still very, very large. In the case of mutual fund industry, is something will remain very, very large, because the multiplier effect. For everything, there is a multiplier effect. The M3 kind of thing that you take, right? So multiplier effect. GDP growth, multiplier effect. Inflation is multiplier effect. The value of money keeps falling on the basis of inflation. So therefore, you need to keep growing. Therefore, for everything, there is a multiplier effect. So you need to also look at the multiplier effect. Where is it high? Is the multiplier effect is going to be continuous, or the multiplier effect is going to be declining in trend? The moment you are able to actually look at the multiplier effect is a continuous trend, then naturally you will probably make an assumption this business will be sustainable. In my own case, if you have to take assembly industry, the reason, maybe for me, of course, it's I remained in the industry for 27 years. Probably I can say by way of luck, or by way of conviction, by way of passion. I only had a passion about my job. I had a passion about my industry. But I was not knowing about whether it will go to 30 lakh crore, 30 lakh crore. We used to stay bullish, of course. But one of the things that we always remain confident, that industry remain underpenetrated because of ownership. Like two-wheeler industry, the next gen will buy a two-wheeler. The next gen also will buy a two-wheeler. Unless two-wheeler becomes irrelevant in the consumers. If tomorrow, if everybody starts flying, right, you have a two-wheeler which will fly, then you will skip two-wheeler, right? You will not buy the two-wheeler which will go on the road. You'll probably buy a two-wheeler which will actually go 2 steps above the road if I have flying capacity. I'm just giving you some imaginary assumptions. So that is the way I think you want us to look at it in terms of sustainability.
Sir, okay, got that.
Yeah.
That's it, sir. The next question is regarding active and passive funds. So we see that globally mutual fund is dominated by passive funds, be it ETF or so like in developed countries, we see that passive funds are dominated. Almost 80% of the population, they do invest passive, whereas it is other way around in India. So like, do
I
you
think your
see
voice
a
is sometimes
like
breaking.
turnaround?
Aditya, your voice is sometimes breaks. You need to be a bit clear, I think. And I understood your question.
Okay, so 80% of developed countries people, they usually invest in passive funds. So can we see a turnaround in Indian markets also, though we are active, more of active fund investors in India? Can we see a turnaround in near future?
Yeah. See, this is part of the disruption. If you look at my slide that you have seen, the last slide I put, the first slide or something, disruptor, right? The ETF is a disruption. And why is happening disruption? Because information available is there everywhere. Therefore, how much analysis you want to do? I mentioned about I used to wait for annual report to come. Today, how many are waiting for annual report to come? Because they have all the information readily available without even reading the annual report. So therefore, the information being available, the market is also becoming more and more robust using technology, and the index formation can be done today for everything. So when I began the career in the year 90s, there was only one index, which is only Sensex. Nifty was not there because Nifty itself was not there. NSE was not there. When I began my career, there was no NSE, there was only BSE. Then came NSE. Then Nifty came. They didn't want to make Sensex 30 stocks. They want to make Nifty 50 stocks. Then Sensex created BSE, S&P 500, 100. Then they made it 200. They made it 500. Then we have mid cap. So today, index can be formed for everything that you want to do. You can put 5 companies and then say this is an index. Or so we can create FANG index, right? Today, worldwide, if you see, people talk about FANG index. When the FANG started, which is Facebook, Alphabet, and Apple, Netflix, and then Google, right? That's the way it's built. And then FANG became, they added in that Tesla. They added Tesla to that. In the FANG index became from a 5-letter word, it became 7-letter word. And there are companies who actually invest only in these FANG stocks. So you can actually create such kind of model. So there is absolutely no rocket science in that. Therefore, that model becoming one. And second is the technology is also playing a role in making investments easy on this kind of product. This will now become the future. But the question is whether it will come at the cost of existing one time. Not necessarily. Existing will continue to exist, and this will keep growing. The rate of growth on such will be faster. The rate of growth for existing one will be relatively smaller. So that's the way I see it.
Thank you, sir. So the next question being, how can one eliminate the risk of getting trapped into, let's say, the financial scams, for example, the Satyam or the Wirecard things? And a follow-up question to that, if someone is already into such investment mistakes, how can he correct? How can a retail investor correct its mistake, provided that he also now doesn't have more capital left?
Yeah. See, it's a very difficult manner because accident is part and parcel of any game. It's like asking a question, can I declare no accident week in Pune this week? Right, Pune highway. Can I declare no accident? Accident will happen. The only thing that regulator will do, or maybe the regulation will do, they'll put a lot of speed breakers. Again, unfortunately, in Pune highway, if we put too many speed breakers, then more accident can happen. Because you think actually there is no speed breaker, you go at 100 km speed, suddenly you realize that the speed breaker is coming in front of you. You apply a brake, another guy will come and hit you in the behind. So instead of saving yourself, you will actually make another 10 guys also meet with an accident. So this is the part and parcel of the game in every market. Nobody can avoid. The only way you can avoid is keeping your greed less. See, keeping your greed less, keeping your agility high, keeping your vigilance in knowing in what are things that's happening, And from a money manager's point of view or individual point of view, what's the kind of bet you take on such kind of companies? See, sometimes you take a bet, you take a larger bet on such unknown names, then naturally your diversification is not there, therefore you get into trouble. Therefore, Satyam is something I still remember in 2009, we were in the front foot, taking up with the regulator, saying what all need to be done, and not to repeat Satyam as we move forward. But at the end of the day, was not known when Satyam was. The only way I think most of the people escape Satyam by not owning Satyam too much. Many would have had Satyam because it was supposed to be a great company and great. Otherwise, if the company is not great, probably Mahindra would not have made money out of that, right? The company was great, but somebody was doing a fraud which not many people are knowing about it. Therefore, detection of fraud, this one would never come to know even our balance sheet analysis. But the only way we can actually ask a question is about the way the company comes to borrow in the market. Because I had met the Satyam Raju's brother who was desperate to borrow money. So that is the time I realized, that time I was investment in charge. That is the time I realized why such a big company is desperate to borrow money. They have so much money, but still want to borrow money. So why? This question which came to our mind. Then we said, no, let us avoid for the time being. There is something seems to be fishy. So that is the way one can avoid such kind of thing. Even for a retail point of view, extremely difficult, but only way you can escape is actually through the diversification.
Thank you, sir.
One last and very important question I would like to ask with respect to all the students here. Like the junior batch, they are having their induction, and for the next 2 years, how should they work on, and what skill set should they have? How to be industry ready, and what exactly do you look in students or people who work for you, or how exactly should we be industry ready in next 2 years? Like starting from today, the day you are mentoring us from the day one to how they should be ready for the market, the process and all the skill sets.
Yeah. So I think the way I see is one, each of you, now that you are part of the industry, part of the capital market, NISM, so naturally your interest to be part of the securities market would also be equally high. Therefore, first and foremost, bring in more passion to that. Don't start with trading. Don't start with stock market. And first start with everything to understand nuances of various components that goes into the capital market in various manner. Like company analysis is only one part of it. Regulatory framework, understanding the regulatory framework, understanding various things which the companies have to be carrying it out from the legal angle, governance angle, regulation angle, or business building angle. And then the third is, while doing this, also understand success stories of companies globally. I think you will be given a case study to do, and case study you can just read and come, or you do actually deep dive in the case studies, apply all those parameters in which one has to analyze the company, analyze the businesses, pay serious attention, form a group of people, exchange ideas, take certain kind of project by yourself, and looking at the success stories of companies globally, and then build some kind of model by yourself to get to more what do you call the engagement high between the teams and between the people, so that your understanding can go up. So your whole focus should be to remove the ignorance and become more and more knowledgeable in terms of the understanding. See, ultimately there is no distance you can cover just being in the institute. Ultimately, once you get into the business, when you get into the work life, then naturally some of these concept I'm saying will come into handy while being in the work life. And this is something as a principle that you must keep while being in the college. I think today's world of case study model, everywhere it works. The more the attention you pay on the case studies, success stories of companies, and then go fully prepared for every discussion, And believe me, this will give you greater sense of understanding of many things. And then when you come to the capital market and take up jobs, whether it is in mutual funds or in the securities company or in the private equity firms and so on and so forth, you will be able to actually get a better insight or maybe better adapt yourself to those organization needs. Apply these principles that you have been learning at the institute. These are some of my simple stuff I wanted to just convey.
Very useful, sir. I guess it would be very helpful for all the juniors right now. I would call upon Akshay to thanks to you. So Akshay, can you please?
Thank you, Ashika. Thank you.
Akshay, am I audible?
Yes, yes.
Yeah,
Am I
yeah.
audible?
Yeah, you're audible, yeah.
Yeah, okay. It's actually an honor to propose the vote of thanks for this auspicious event. On behalf of my college and the entire batch of students, I would like to express our sincere gratitude to Balasubramanian sir for sharing his wisdom and experience to all of us here. The concepts like going from stories to numbers and importance of deep analysis, all these life lessons is going to be very important for the students out here. Also, I take this occurrence to thank our college, also the registrar sir, Sahil Malik sir, and also Rajnan who is here, and also our program director, Ritesh Samdani sir, who actually inspired and also supported us a lot to take this event and manage and complete this event successfully. So also the entire APU team and also the faculty members for their constant support in our development. Without all of these people, this event would not have been possible. So they were a very important part of this event. Having said that, no event can also happen without the enthusiasm and eagerness of the students out here. So I thank all of them for participating here actively and representing their valuable views here. So to conclude with, there was one revolutionary writer who wrote that let the flowers be crushed, but spring will come one day. So we all know we are all continuing to learn during these hard times, like this the time of pandemic. We are fighting a pandemic. This will obviously improve our temperament, resilience, and also our eagerness to learn more. Let us all hope that that times will get better soon, and God will bless us with the spring of happiness going forward. Thank you all. Thank you, sir. Thank you all for participating.
I would like to call the day sir to please present the certificate of appreciation to Bala sir. Thank you so much.
Thank you, Harshika. Thanks a lot, sir, for this insightful and motivational address for our students. I'm sure they would definitely keep all the guidance and tips you would have shared with them. They would definitely keep these words of wisdom in their heads, and it will definitely help them to make productive use of next 2 years at NISM and also to prepare themselves for an enriching career in securities markets. Whenever we hear Bala sir, we always feel that if we could have heard him more, we always never realize when the time flies, and we always wish to hear him more and more. Sir, thank you once again for always being available for our students and for NISM. We hope once the situation normalizes and we can invite you at campus and we can continue these discussions maybe in physical form next time. Thanks once again, sir. Since we are connecting virtually, we thought we can present the certificate of appreciation to you for your time and more importantly for sharing your experiences with all our students. Thank you, sir, and we look forward to listening to you in many more opportunities in future. I request all the students to please join us in once again. Had we been physical form in classes, I'm sure all of us would have loved to give you a standing applause. But at best, I request all of you to please join us in giving a virtual applause to Bala sir. You may feel free to unmute your mic and applaud sir for his time and for his inputs.
Thanks, Ritesh, and thanks, Harshika and others. I think it makes my pleasure to be part of NISM always. And again, being part of students, it again gives you a new way of engaging, new way of learning. And also eagerly waiting for, I think very soon I'm sure it will happen. But anyway, I've been traveling, absolutely no issues. If all of you on this, whenever you're in the school, and whenever there's an opportunity to come and visit all of you at the institute itself, I'd be extremely happy to come and have interaction with all of you directly. Thank you.
Thank you. Thank you, sir.